Hello and welcome to Business Television India. You're watching Market Guru with me, Piyush Jain. Joining us on the show today is Mr. VK Sharma from HDFC Securities, the head of capital market strategies from the PCG. Mr. Sharma, welcome to the show. Now, it has been a couple of days, and within this span of time, since the last time we actually had a conversation with you, there has been immense volatility in the markets. It's not only volatility, there has been correction, there has been a return of correction in the small caps, large caps have fallen. So again, definitely again, retail investors have been seeing a lot of pain in the markets at present. Now, the question here is basically, this is a question which has been put to me like by a lot of retail traders. And that question has been what they should be doing right now. Should they be actually going out and actually investing into the markets? Is it a good time, or there are more sort of corrections coming, or they should go for large caps or small caps? How they should actually, and also there are a lot of mutual funds actually at present, they actually have fallen a lot in terms of NFTs also. So at present, the strategy, what the retail traders, the investors again, what they should be doing?
Yes, I think very important, Piyush, because at this point of time, we have also, when we speak to customers, this is their biggest.
What they should be doing?
Yes, I think very important, Piyush, because at this point of time, we have also, when we speak to customers, this is their biggest problem. While the biggest concern is, while the index has done well for itself, it is down only 1.5% or so in the current year, as compared to their individual portfolios, which are washed with red, almost 40-50% down.
Yeah, very strong.
Yeah. So if you look at the mid caps, 20% plus down, and small caps more than 30% down. So essentially, what we need to do at this point of time, or we're suggesting to investors, is that you cannot drive your car at 120 kilometers all the way. So you have to take a break and you have to go according to the conditions. The prevailing conditions are slightly, they are risk averse at this point of time. So lie low, do not be very, very aggressive. So at this point of time, we should combine the benefit of ETF and small cap mutual funds.
Okay, so you're saying index ETFs?
Index
so
ETFs.
Basically buying them. Low cost product.
Low cost product.
A product which goes into your demat.
Yes.
So basically you have exposure to index.
Yes.
And then you're saying go for a slightly, which we say, higher risk, higher return, a product like small cap mutual funds.
Mutual funds.
Why are you saying like that?
Yeah, I'm saying this because while investors are sure that the index will go up, their individual portfolios may not go up.
Right.
So even if you start an index fund, let's say start index fund through SIP route, at least for the next 1 year, because uncertainties till the elections, and maybe after that 3-4 depending upon what kind of government we have. So if you do an SIP, Piyush, so you will have a great advantage in the sense that you will be averaging every month.
Right.
And this itself will mean that you will be able to get good returns, primarily on the basis of the fact that the index will purely reflect what has happened in the markets or how the events have happened, whereas your individual stocks may not.
Right.
So this is, I'm suggesting, I will give you a live example of the past where, so currently the biggest problem with the investor is here the markets may fall. So let them fall. I give you example of January 2008 when the Nifty was 6357. It started falling and it reached a low of 2252. That is 61% down in a matter of 10 months. And people must have been bewildered. But anybody who was doing an SIP in the Nifty ETF for every month, he broke even when the Nifty, after touching the bottom, when it came to a low of a level of 4,650.
So you're saying from 6,300 to 2,200 odd, the Nifty fell, and
yes.
Again when it returned around 4,300, because if you were purchasing continuously,
yes,
anywhere between 4,000 4,500, you would have just started breaking out.
You started breaking out from that level.
SIPs are better.
SIP is better
in a falling market when you don't have any clarity where is the bottom,
yes,
what's going to happen.
Yes, exactly. Because you cannot average individual stocks, no matter what part, because individual stock may be eventually be thrown out of the index also. Okay, so that is the charm here.
Sometimes there is also a question again from the investors that are we staring at a sort of bigger meltdown like 2007-8 this time? So should we just wait for some time and then start doing SIPs? or you think this is not 2007-8, we can continue to do SIPs? Like, you know, those very common questions actually, those come. So do you have at present, like, how are you looking at the markets, all sort of liquidity scenario and everything happening around us? Like, we are getting a lot of negative news flows. Today again, basically RBI give us another liquidity boost. We have been hearing about some defaults from the real estate companies. Before that, actually, we were hearing about commercial paper liability mismatch here. From that scenario, what's your own sense on the markets at present?
Okay, my own sense of the market is that the markets at the last year when we were speaking, earlier this year, we said market will make a high. Ultimately, a new high was made. But now, once a new high has been made, now the fall of the market is faster than what it was earlier. So therefore, there are chances that market could revisit its low of 9958, which it touched on 23rd of March. And if that is saved, then of course we are looking for a revival.
And that is not saved?
If that is not saved, we are headed much lower, maybe to around 9,200 or 300 levels.
Could be a sharper question. If actual levels are...
If at all those levels are broken.
Yeah.
But right now we have seen that ultimately those kind of levels, if they're broken, they do not bring in that kind of sales, because the local consumer, local investor has come in.
And
the FIs, the SIP culture. Each month the SIP is improving.
Right.
So this is no way the reputation of 2008.
Then you have EPFOs, you have the insurance funds, you have a lot of domestic participation.
More importantly, while the index has gone down, the FIs who have sold earlier in the year, they'll find it very, very lucrative to enter back, because the currency has depreciated another 16% from the high, and what more do you require? So
at a 10,000, 18% correction on the index, then you are talking about 15-16% currency depreciation. You are talking about 25% dollar correction here. So perhaps more than 25%. I'm just saying a number here.
Yeah.
So you're saying basically that would actually make FIs really feel that the Indian markets are very attractive.
Yes, definitely they'll come in. But what I'm saying is, a bear market in India has never lasted more than 18 months.
18 months.
18 months.
Right.
Okay.
And so we are still almost 6 to 7 months already.
Let's begin from the high. Right. So the high was made in August.
Right.
So okay. So another 16 months to go. Let's say even that. So no issues. I mean, if you do an SIP, you are through.
Right.
You don't have to time the market. You can time the market with individual stocks. Now there are some people who are not comfortable with an SIP.
Right.
Large people who are equity oriented. Don't worry. If you see a 5% fall, by all means put in your 50% of the money. Another 5% fall, put in the rest. And if you're putting in the ETF, you are sure that this journey is going to come back.
Right.
The index will come back no matter what happens. Individual stocks, there is no guarantee that they'll come back, no matter even if what it is, because for the 50 nifty stocks that are there, they will always be 50. But there have been 94 changes, Piyush, since 1995. So
in terms of stocks going in, going out,
while you might, for an investor, might feel that I'm only putting my money in and passive fund like in, it is not passive. It is passive for you, that you, once you buy, you don't have to do anything. It is active from the fund manager point of view, who is mirroring any change in the Nifty that happens.
Right.
So it is much better in this kind of a market, and history has shown that it is best when it's done. When you feel that the market is going to tumble, SIP is one of the best routes.
You're investing at lows.
ETF.
So the chances of returns again basically are much higher.
Yes.
Also one question again, you actually talked about a sort of combination strategy in terms of small cap mutual funds and then index ETFs. Small cap mutual funds, small caps themselves again have taken a large beating. Now there has been a change in terms of correction patterns, small caps, then large caps, then again small caps. What's your own sense right now? Have the larger part of the small cap universe, we can talk about the most covered small caps, or from that perspective, has the correction already been seen, or you think we can actually still see some more pain there? Because many of the top covered small caps, they've already fallen actually 30, 40, 50%. So how much worse actually can it become?
So that's right. That's why I'm saying that the mid caps and small caps can fall or will fall less than the larger caps going forward.
That looks like now.
That looks like. Okay. So if you don't have the capability of putting in the mid caps and small caps on your own, these funds are the best route. So also, it's a well-known thing that Warren Buffett did the best thing in terms of 2008 during that crisis. He bet that anybody who will beat the S&P 500, I'll give him $1 million. So hedge fund manager took his bet and he lost. So essentially, no matter whether you are a very well-known person or you are a fund manager or a normal person, investment in an ETF makes sense. It may not, it may be to us only a certain extent. Now, if I were a fund manager, Piyush, and my objective is to beat the index, I'll put in 50% of my money in the index itself.
Right.
And with the rest, I'll try and beat the index with other things, because I don't have to worry about this 50%,
right,
because the indexes will automatically take care. So ETF is not only good for small investors, but also for large investors when it acts as their, let's say, storm of shelter.
Right. So small cap mutual funds, index ETFs is something which you are at present comfortable and think investors should look for those here. And now, you want to say?
Yeah, one more thing, that this is, if you have a Nifty ETF, this is the most, let's say, protected asset. Options are available in the Nifty at the cheapest rate, and they are the most liquid. Tell me, can you protect your fund, any other mutual fund? You can't protect it in a similar way. You will either have to sell it or you have to hold it.
Right.
You can't have your cake and eat it too. You can do that in case you are in a ETF, because what is your underlying asset? Underlying asset are the Nifty stocks, and what you buying a put in the Nifty protects your portfolio to the T. Right. Exactly. Which is not possible in any other mutual fund, because those, first and foremost, all the stocks may not be there which are there in the fund. There is no way, and for a small investor, you can't have, it's not possible to hedge all your portfolio.
Let me put a very layman question again from the perspective of retail traders again, so that they can understand this. When you buy a Nifty ETF, do you also get dividends? And is that something happens or doesn't happen? Like I'm trying to ask from the traders.
Okay, good perspective. See, sometimes the ETF pays dividend, and sometimes it just holds back. If it holds back, the NAV goes up. So, for instance, the most popular, which has been in the last many years, let's say, is the Nifty Bs. There, the last 3 years, they have not paid any dividends.
Okay.
But as such, the dividend, 1.3 dividend yield of the Nifty is around 1.3%.
So they don't pay dividend, which means they must be trading at a continuous premium to the
continuous premium. Yes. So slight, so it gets adjusted. So you don't have to worry about it.
But even if somebody is paying dividends, it would be roughly 1 to 2% dividend yield, not more than that.
No, the Nifty yield itself is 1.3.
Right.
They'll deduct their expenses and give you the money. Right. So which will be the charges, asset management per se charges are only between 0.1% to 0.15 depending on which fund you're talking about. But more importantly, very less as compared to a regular mutual fund equity.